Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
Right now, I'm looking at WTI crude futures. They're up as much as 1.3%, just up about 0.5%. We did see a jump in oil earlier, though, but it did pull back off those highs, as President Trump said. He denied making a decision to strike military targets in Venezuela. It's something we talked about in our 2 o'clock hour. Also, ExxonMobil and Chevron outperforming Wall Street expectations after new oil field projects and acquisitions boosted crude output. We wanted a big picture view on where Venezuela fits in, but really where we are in the global oil markets.
Let's bring in Dr. Ellen Wald, president of Transversal Consulting, also senior fellow in the Atlantic Council. She's also the author of Saudi Inc. Ellen, good to have you with us. Welcome back. I want to start with this idea of a potential military strike on targets in Venezuela by the United States. The president denying that he'd made a decision to strike military targets in Venezuela. Look, whenever we have a conversation like this, we're talking about a military operation, but we're also talking about the economics of it. So we're going to try to separate
market implications,
the market implications from everything else. I am curious about the market implications if the U.S. were to strike Venezuela. What would that do for oil?
So I can see why oil spiked a little bit earlier in the day when it wasn't exactly clear what's going on in Venezuela. I think it's still not exactly clear what in the world all of these U.S. warships are doing right off the coast of Venezuela or approaching Venezuela. But it doesn't seem like we're about to strike Venezuela, which I think was probably never really in the plans, mostly because we're not about to invade Venezuela. I think that there's a concern, certainly, that if there is any kind of political instability in Venezuela or military activity in Venezuela, that could have the potential to impact Venezuela's oil exports. Now, keep in mind, Venezuela's oil is actively being sanctioned. So all the oil that it's selling is really all on this kind of black market, goes to China or goes to Iran, or at least it used to be going to Syria. And so technically it's not really, or it shouldn't really impact the larger oil market. But of course, everyone knows that there's this large black market for sanctioned oil going on. So, the potential for any kind of disruption does impact the oil market. And so we saw that happening today.
Hey, so what's a more important fundamental story when it comes to the energy markets, the oil market? Is it really what's going on in overall global supply and demand?
I do think that is the most important thing underlying, but I do think that there is a lot of confusion about what exactly is going on with supply and demand, because you have some of these big, global kind of agencies that keep track of supply and demand saying, hey, we're in a massive oversupply right now. And then on the other hand, you have other agencies like OPEC saying, no, we're not in such a big oversupply. And you have, the Saudis coming out and saying, we're not all that oversupplied. OPEC is going to pump more oil. And so I think that there's some confusion, or at least disagreement, about how much oil is on the market, how much oil is being pumped, and how much and what oil demand is. And I think that that's understandable given how incredibly complex the oil market has become recently with all of this sanctioned oil going different places, and they're saying it comes from one place when really it's coming from the other. And so there is a lot of confusion, rightly so. I also think that there is a lot of trepidation about the economic condition, where we're going economically, kind of as a world, as the global economy. And so that makes it hard for people to figure out, how much oil should we be pumping. And so that's one of the reasons I do think that we have seen oil prices remain fairly low. And at the same time, we're not seeing any kind of pullback in terms of production.
Well, let's go there. There's a story on the Bloomberg today. Ellen, U.S. oil production climbed to a fresh record near 13.8 million barrels a day in the month of August, according to a monthly government report. Number was higher than official figures previously indicated. Apparently, there are some government reports that continue to come out.
Okay.
Sorry. But so U.S. oil, our production here, I think I heard something earlier on Bloomberg Surveillance, maybe it was with Tom and Paul this week, about, just the amount of oil that we are producing here in the U.S. What's your expectations, and where is all this oil going? And do we?
Yeah, this is a great question because, we have, we get these reports weekly, but they're not all that accurate. What they really are estimates. And so once we start to get these reports coming, it's now the very end of October and we're finding out what really was produced in August. And wow, it's a lot higher than than the forecasts were. That really says something. I mean, 13.8 million barrels a day is an absolutely massive amount of oil that we're producing in the United States. And it's clear a lot of that oil is going into our own refineries. It's being used. It's being turned into products that we're using. But we're also exporting a lot of oil. We're exporting to Europe. We're exporting to China. We're exporting, all over the place. And I do think that is very, very significant at this time. I do think there's a lot of discussion about, has fracking peaked? Is the Permian peaking? And when we get a data point like this, it tells us that maybe it's not peaking. Because there were people have been looking at these estimates and saying, hey, maybe we're finally seeing it coming down. Well, maybe it's not, or maybe it's not going to come down as fast as they thought it was. And that's going to lead to more supply being on the market than people thought there would be. So sometimes we see a disconnect between what the forecasts and what people think it should be, and then actually where it is going.
Where does China fall into this in demand or lack thereof coming from China right now?
That is a really interesting question because China has definitely got strong demand, but then the question is, okay, is it going into their, is it going into their economic system? Is it being actually used, or are they putting it into their absolutely massive stockpiles of oil? Is it going into their kind of independent refinery system that's producing products and then selling them all over Asia? And so it's hard to get kind of a handle on what China's economic situation is, what they're producing there, when we're not entirely sure where all that oil is going. Plus, now you have this issue with Russian oil. We know that China imports a lot of sanctioned Russian oil. They import a lot of Iranian sanctioned oil. They import Venezuelan sanctioned oil, and they hide a lot of that. And so we may not know exactly where their oil is coming from, but it's possible that soon they may be at least cutting back on some of their imports of Russian oil. And so that is important for the future of global oil markets.
So glad we could check in with you. Dr. Ellen Wall, President of Transversal Consulting, Senior Fellow at the Atlantic Council, author of Saudi Inc.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Netflix is actively exploring a bid for Warner Brothers Discovery's studio and streaming business, that at least according to Reuters, citing people with knowledge of the matter. Now, remember, Bloomberg News reported earlier that Netflix and Comcast are weighing bids for parts of the company. Comcast execs discussed their M&A strategy on an earnings call earlier in the week. Meantime, we are also, focused on those Mag 7 Amazon shares, Tim, are soaring in a big way today.
With more and a look at the big tech earnings week that was for Apple, Meta, Alphabet, and Amazon. Back with us is Laura Martin. She's senior entertainment and internet analyst at Needham & Co. She covers the media, entertainment, the worlds of internet as well, which, as we know, have become so intertwined. She joins us from Los Angeles.
Laura, great to have you back. Hello. We got to start with Netflix and Warner Brothers. We've talked with you before. We did it at Bloomberg Screen Time out on the West Coast, and it was just after Netflix co-CEO Greg Peters was like, we're not interested in Warner Brothers. You said that even though Netflix doesn't do big acquisitions, you did know that they must buy established IP, intellectual property, and you talked about this. So do you feel like there's momentum here that Netflix is kind of moving towards a deal?
I think that it's a smart move for them to look at the books of Warner. They lose nothing by doing the due diligence and looking at Warner's business model. I think Wall Street would be supportive of Netflix using its very valuable equity to buy the studios. I do not think Wall Street would be amused if they tried to buy the linear TV networks. And I think that, I think there's a disagreement within Netflix. You're right that when I last saw you, Greg Peters was like, hard no, we don't want to look at these assets. Ted Sarando's body language on his earnings call was much more open, probably because he's the content guy. And Warner Brothers has some of the best IP and the deepest library of any studio. And once you own the IP, you never have to pay to rent it again. So it's really hard to keep creating brand new IP. You may as well get some that has an installed base of fandom from the last 50 years, and Warner Brothers has some of the most, next to the Walt Disney Company.
So should Netflix do it?
I think it depends on price. Because it is contentious within Wall Street, it depends on price. And I get the sense that Warner Brothers really wants to sell dear because they have this idea that if they split in half, they're going to get $26, $27 a share of total value. I don't believe that. But if they believe that, then that means that they're going to try to overcharge Netflix. And I don't know that Netflix would be overpaid for the studio assets here.
Who else? I mean, we talked about Comcast. I mean, who else could be, a really big competitor here for Warner Brothers?
So I think, my opinion is the way this plays out is everybody looks at the books. Everybody gets the inside scoop on what's happening at Warner Brothers, because why not? You're competing against them. And then the price, and then they try to buy a piece, like Comcast tries to buy linear or Netflix tries to buy. And I'm not sure they are regulatably approvable, except for Larry Ellison, who is Donald Trump's good friend. So I think all of this is in the end, a way to get Larry Ellison, David Ellison, to get their price up to match whoever else is bidding. But I think Ellison's are the only ones that can get this to regulatory, in my opinion.
What ends up happening to the linear stuff over at Warner Brothers?
Well, Ellison has said he's willing to buy the whole thing. So that solves that. They just sell the whole thing because he can get regulatory approval.
Huh? Okay.
God, it's fascinating.
I think we'll have Laura back on before this. and still, our first question will be a month from now about this potential deal.
I know. Is there any pressure to get this thing done sooner rather than later?
No, I mean, the CEO Zaslav is trying to make pressure because he's saying, in April, we're going to split it in two pieces. But it's an arbitrary deadline. He can push that off to June or September. I don't agree that the two pieces spun off alone will be worth 26 or 27. But that's his stalking horse, is this artificial timing deadline he set.
So let's say Netflix doesn't get this. And I promise we're going to ask you about more stuff, Laura. But let's say Netflix doesn't get assets from Warner Brothers. What would be its next move in content IP? What should it do?
So what I think it's doing, interesting things with advertising, interesting things with video games. It's going into short form, which is smart. It's backing creators, which is smart, influencers. It's moving into the YouTube businesses and socially connected people. It's doing physical. You saw it's doing physical around K-pop. It's #1 film of all time. Physical outlets, the way Disney does, but they're doing pop-ups, a much smaller much smaller vision than the Disney vision of theme parks. So they're doing a lot of things that are trying to maximize revenue from their IP. I would like to see them buy a library, but I don't want to see them overpay for a library.
Okay, last one on Netflix, announcing yesterday a 10-for-1 stock split. The split-adjusted basis trade is expected to begin on November 17th. Shares up 2.7% as we speak. I'm a big, hey, this doesn't change the fundamentals of the stock, so I'd have a hard time ever understanding. Yeah, I do. Whenever a company does a stock split like this. Your thoughts on the stock split? Do you care?
No, super smart. This is a retail company, and people should be able to give. When I was a kid at 5 years old, my grandmother always gave me 5 shares of the Walt Disney Company, which we should deliver in a frame, which are still on my walls, every birthday for 5 years till I was 10 years old and wanted a different thing, dresses or something. So they should be doing that with Netflix shares. And this should be accessible to the public that wants to be supportive in the capital markets on a retail investors of the fact they love Stranger Things. It's another way to sort of give a feedback loop to Netflix about the good work they're doing. So I'm very supportive.
All right, great stuff. Hey, let's talk Mag 7. Amazon, Alphabet, Apple, Meta. What a dump this week. Investors reacted differently to the AI spend at different companies. Pick your company that you think was most interesting this week.
Okay. So the two most interesting were Amazon and Meta, because one's up 12%, the other one's down 12%. In total, these companies each raised their capital spending guidance for this year by $7 billion. Together, the Mag 7 will now spend $400 billion on generative AI infrastructure, going up to $500 billion next year, $500 billion, in a revenue stream that isn't determined yet. So that is a big headline here. Capex spending continues to, rotate up. Amazon, really spectacular numbers. Really, Amazon is trading on AWS. Like, you may think it's an e-commerce company, but capital markets are telling you AWS is what it trades on. They've reported 20% revenue growth at AWS, which is the highest in, I think, 3 years, 300 basis points faster than last quarter, so accelerating. It did $33 billion of revenue out of 105 total that revenue for the quarter at a 30% margin. Remember, e-commerce has a 2% margin. So think about what's happening to returns on capital. And, okay, so you're going to say, oh, but they're spending all this CapEx, so it's unclear. But what's great about Amazon is everything they're building for generative AI, they are using internally to lay off 14,000 people. So they're improving their operating efficiency, and they're driving revenue growth in all of their businesses. And they're going to sell. They are the only one not capacity constrained, because 4 years ago, since 2022, they have doubled their power capacity, which is the gating factor to data infrastructure. And they created Trainium chips, which are their proprietary, what they call custom silicon. So they don't have a capacity problem. Whereas we hear from Microsoft and Llama over at Meta and Alphabet, they're all capacity constrained. That's silly. Amazon's running a better business. Good for them. Go Amazon. So they are not capacity constrained, and they have differentiation by these Trainium chips. Let's move to Meta. Meta, the opposite. They're like, we're going to take on all this money. They spent $19 billion of capex in the quarter, which left them only $10 billion of free cash flow in the quarter, which means next quarter, when they spend more, they're going to go into negative cash flow, which means they're going to be borrowing money from capital markets. And when he tells you about what his goal is for this huge capital spending that's going to drive leverage, adding financial leverage to his income, his balance sheet, he's saying, we're going into the super intelligence business, which is going to benefit the world. And it's going to be, some experts see 3 to 5 years from now, some say 7, and some say after that. To which I say, too much value leakage. Yeah. Wall Street investors should not be in the business of buying Meta shares to benefit the world. The Pope does that. There are people who have a seat that does that. No, buy Alphabet. Everything they do is about capturing the value of the capex that they're building, both for themselves and leasing it to third parties at increasingly high margins. So I don't like the value leakage. I don't want to save the world through a corporate investment. Get out of Meta, move into Alphabet, move into Amazon, and Apple's just not in the game.
Laura,
just double their capex.
We only have 10 seconds left, but if Amazon's market cap is $2.65 trillion, excuse me. You say that's all AWS is what it's traded on. What portion of that is the value of AWS? Very quickly.
I would say this is what it trades on, but I'd say half of the value of this company is now based on AWS outlook.
That's incredible.
Laura Martin, we could talk to
Andy Jassy is the CEO.
I know. We could talk to her forever. Have a great weekend, and I know we will talk with you soon. Amazing. Laura Martin, Senior Entertainment and Internet Analyst at Needham & Company.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Shares of Amazon up 10.5%. They were up as much as 12% earlier in the session. This after the company reported third quarter results that beat expectations. AWS, that business especially strong. A bunch of banks, including Morgan Stanley, Truist Securities, RBC Capital, raising their price targets as a result of the print. Also raising his price target, Tom Forte, Managing Director and Senior Consumer Internet Analyst at Maxim Group. He's got a buy rating on the stock. He's increased his price target by $8 to $280 per share. Tom joins us this afternoon. Tom, good to have you with us on the program. I'm wondering about the specific price target increase. It was a pretty blowout report. Stock surging, as I mentioned, 10.5% right now. You raise your price target by $8. Why not? Why not more?
Yeah. So when you think about our price target for Amazon, it's pegged to an enterprise value to EBITDA. And I do think, as crazy as this sounds, on that basis, there's an opportunity for expansion in the multiple as the company improves its profitability led by its cloud computing effort. So I would say that the $8, call it modest increase, was a reflection of a slight increase in our profit expectations coming out of the quarter. But I do think as they continue to improve their margin profitability or margin over time, that there actually could be some expansion in the multiple for Amazon, which is somewhat unique.
All right. So what kind of improvement, Tom, could you see in that margin when it pertains specifically to the AWS business? And how does it get there?
So, Carol, if you think about Amazon as a software company and not as one of the largest retailers in the world, that's where the opportunity comes. So when you compare it against other software companies, they're trading at enterprise value to EBITDA ratios of north of 30 times. So by no means am I suggesting that Amazon will get to 30 times from the high teens today, but I think directionally it could head there.
Am I crazy to bring this up? This was like something that people talked about a couple of years ago, Tom. Should Amazon just spin off AWS?
So, Tim, the challenge for spinning off AWS, I've spent probably too much time thinking about the sum of parts for Amazon. So the cloud computing business is clearly very valuable. Over that 3-year period, the advertising business has become a lot more valuable. When 62% of items are sold on Amazon, they're sold by third parties, not Amazon. That's a relatively healthy margin business. But the remainder, where Amazon's the seller of record, they're probably break even. So I do think on the strength of advertising and cloud computing, the sum of parts may be worth more than the whole, but you still have a pretty big low margin e-commerce business for Amazon. What happens to that in the case of a spinoff?
So, you know, what we got some color on and specifics on, Tom, on the earnings was, you know, we know Amazon is backing Anthropic, that investment of $8 billion, but we got some idea of the impact of that company. So I'm just curious, you know, AI and what they're doing, their whole strategy and the build out and the spend, you're comfortable with?
The build out and spend is enormous. I mean, it's kind of scary to think about more than $100 billion in capex for Amazon. But what I think is interesting when you compare and contrast Jeff Bezos running Amazon with now Andy Jassy doing it, is that Andy focuses on both the top line and the bottom line. And I think the reason he does that is to give the company the ability to generate profits while it ramps investment spend. So I spent a lot of time, Carol, thinking about why are they laying off all those people heading into earnings? What does that mean? And I think that Andy's trying to run a business where he cares about margin a lot more than Jeff does. And the reason is so he can continue to invest in the business, but maintain profitability.
Well, look at his DNA, right? Where did he come from? AWS. He's the guy who created
AWS. Exactly.
AWS. So
exactly. Yep.
So it's not necessarily the retail DNA.
No. So yes.
But what is that?
He's clearly running Amazon as a services company collectively.
So where does that leave the retail business? I'm just trying to get an understanding of how investors should value it.
I mean, sales increased 10% in the third quarter.
But remember, they're eating tariffs.
Right.
So
it is remarkable how insulated they've been from tariffs. Again, it speaks to the marketplace model. 62% of the items sold by third party, not by Amazon. And Amazon and those third party sellers know that if you want to win the buy box, you have to price competitively. So I don't think you're seeing inflation have as negative impact, or tariffs and inflation on Amazon's retail sales as you're seeing at Walmart, Target, and other retailers.
But Tom, to Tim's point, I mean, we all think about Amazon, you know, in a big way as this retail company that, you know, miraculously puts things on our doorstep in 24 hours.
Yeah, mostly groceries for us.
Yeah.
With Whole Foods, thanks to that acquisition.
Lots of stuff, right? But I mean, we know the bread and butter and the gold of this company, or the golden aspects, is really AWS. But having said that, would Amazon be as interesting without that retail component?
So if you think about it, let's compare and contrast it with Alphabet and YouTube. Mm-hmm. So you have Google Cloud and you have YouTube. In the case of Amazon, call it the birth of AWS was to give the retail effort the capacity it needed from a computing standpoint. So I do think that there is an element where the two go hand in hand.
So I always like to ask folks like yourself, and I do this with our reporters too, if you were sitting down with Andy Jassy, what would you ask him? So
I would ask him the future of Amazon and what will be the next pillar. So if you think about Amazon, you think about healthcare. I'm a One Medical customer because I want to learn all about their healthcare efforts. You think about Amazon Pharmacy. So what is Amazon going to do in the future that it isn't doing today? You think about Project Kuiper and high-speed internet via satellite, things of that nature. So what's Andy's vision for what Amazon will do in the future, and what are areas where he doesn't want to pursue? So how's he making that decision on where to expand and where not to expand?
All right.
That is what keeps me up at night thinking about Amazon.
Tom, 45 seconds. So I'm going to be Andy Jassy, and I'm going to throw it back at you. So Tom, what do you think we should do?
So in order to maintain the stock price, so I've published 27 white papers on the convergence of tech and retail, 3 on the death of Amazon, essentially what could slow the stock. They need to maintain growth. So I do think he needs to continue to find large trillion-dollar market opportunities like healthcare. So I do want him to expand there, not just as a consumer looking for a better healthcare experience, but as a longtime analyst of the company.
Just 30 seconds on Project Kuiper. Do you think they stand a chance against SpaceX and Starlink?
Do I think they stand a chance? So let's call them a distant number 2. So I still like what Elon's doing with Starlink, but I think it's interesting what they're doing with Project Kuiper, and understand why both Starlink and Project Kuiper are trying to bring high-speed internet to parts of the world that don't have it today.
Hey, yeah, good for AWS if everybody can get online.
Right?
Yeah.
Exactly. Tom, this was really terrific. Thank you so much. Have a great weekend. Tom Forte, Managing Director, Senior Consumer Internet Analyst at Maxim Group.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
A great and timely column from Bloomberg Opinion on the terminal today. Thank you, Carol Masser, for sending it my way.
You're very welcome.
Okay, so Laura Noonan writes that the sport of running, it took off in the 1970s as a low-cost fitness trend. It's turned into a playground for the wealthy. One Citigroup exec who took up running 6 years ago has spent tens of thousands of dollars on hundreds of personal training sessions, regular blood tests, countless massage treatments, 3 hours a day of training. I want to know what type of executive can do 3 hours of training a day. That's what I want to know.
I don't know.
That's
a very efficient one, I guess.
Yeah. Well, Dan Sheridan has also spent decades thinking about running, not necessarily spending as much money in 6 years training for a marathon, but getting people to buy his running shoes. He's the CEO of Brooks Running. It's the Seattle-based subsidiary of Warren Buffett's Berkshire Hathaway. You know their shoes. The company, though, also makes apparel, sports bras, accessories, and more. Dan joins us here in the Bloomberg Interactive Brokers studio. Welcome. How are you?
I'm well. Thanks for having me. This is great.
How's business?
It's incredible. We just finished our third quarter up 17%, and all regions for Brooks are growing double digit right now.
So that's the top line. And that's growth. That sounds great.
Yeah.
What about the bottom line with these tariffs?
So we don't report our bottom line publicly, but I would tell you that we are having a great year in terms of top line and bottom line. And it's really based in this participation that we're seeing around the world for running and walking and just movement in general.
On the bottom line, controlling costs around tariffs. Your shoes are imported. Right. Are any made in the U.S.?
No, not at this time. Southeast Asia is where we manufacture our products.
How have tariffs hit? your company?
Yeah, it's been challenging. Since 1930, the athletic footwear industry has had really high tariffs, 20% on average. And so this new round of tariffs increased our tariffs by 100%. We now have 40% tariffs out of Southeast Asia. So we had a big math problem to deal with. And we've got our arms around it. It's now at a place where we think it's going to stay at this rate. And so we're working the whole value chain at Brooks to really address the costs that are coming into our products. And again, I think we have our arms around it, but we're just starting to see the tariffs kind of roll into cost of goods right now.
So Dan, you went from what tariff to 40%?
So we went from 20 in Vietnam, where we're predominantly manufactured, to 40% now with the August announcement of tariffs. So,
how do you manage that?
Yeah, it's really tough.
Where do you squeeze things?
It's tough. We tried to really be holistic in this approach. We didn't want to, one, raise prices and dampen demand or punish consumers.
Yeah.
So we looked at the entire supply chain, worked with partners, long-term partners that we've had for 25 years, all the way through distribution and transportation to get our costs to a place where we could raise prices moderately and not dampen demand and punish the consumer.
Is this the world we live in moving forward? Is this a permanent thing, you think?
Yeah, I think the history of tariffs is they don't roll back. And so we're planning long term for, higher cost inputs on duty. We sell in over 50 countries around the world. So global trade for us is super important.
Does it make you think differently about your supply chain? I mean, look, at the end of the day, the president wants everything to be made here in the U.S. We've spoken to a lot of CEOs who say, we just can't do that. I mean, Harmeet Singh, the CFO of Levi's, was on our program, and he was like, we're not going to make Levi's in the U.S. Yeah. It's just not going to happen. Are you ever going to make Brooks in the U.S. again?
Yeah, I think the way we think about it is, for our supply chain, we have to build agility and resiliency into our supply chain, because a lot of the things that impact supply chains are out of our control. Trade policy, just governmental policy as well. And so we're building agility and resiliency. We also are starting to work on automation in the footwear process. One of the secrets of performance run product is it's manual. 500 people touch a pair of shoes from the start to the finish. And so automation will change. And that could open up new markets for us, new countries to manufacture in.
If you can increase automation, would it make it possible to manufacture in the U.S.?
Potentially. I think that the challenge, though, is that the entire supply chain of material is based in Southeast Asia. So we have to solve that problem as well. Otherwise, we're just importing goods to final assemble in domestic markets, and the imports would have duties on it as well.
Is the president listening? Is the White House listening to your industry?
Yeah, I think we've got really good trade organizations that are, lobbying on our behalf. And so we're making some progress, but I'm not sure we're at the top of the list. This administration has said they're not trying to make shoes in this domestic market. So we're hopeful that we can navigate this, but we do have our arms around it, and we feel like we've got a path forward in terms of pricing and supply chain.
Well, let's talk a little bit about brand positioning for Brooks and how you think about Brooks's position within the entire industry. I don't know if you've noticed, Dan, but there
are tons of sneaker choices out there.
I love it. Yeah, I mean, look, we've had the CEO of On our program. We've had New Balance's CEO as well. No question, there's a lot of competition out there. Nike's challenges have been well documented. Where does Brooks fit in?
Yeah. There's 1,400 people at Brooks that get up every single day, and all we think about is running. Runners, their experience, the products that we deliver. That is our positioning. We often say at Brooks that our sharp focus creates mass appeal to anyone that moves. But our North Star is runners and the lifestyle of run, the community of run. So that's our positioning, matched with innovation that solves for the runner. Real innovation every single day based in biomechanics and science, matched with trends in the markets. And that has been a great strategy for us. Over a 25-year period, we've grown over 14% compounded. And we have consistent growth because we're based in science and we're delivering products that are meaningful in runners' daily lives. And it's a great position for us.
What does that science look like? Give us an idea of like what is going on in a lab or labs and how you guys are innovating.
Yeah, well, in Seattle, Washington, where we're based, we have a biomechanics lab that we invest a lot in R&D and innovation through that lab. We're doing deep scientific study on how people move through the gait of running. Our goal is to reduce injury and improve performance in everyone's life. And so that lab, based with partners in Asia and institutions around the world, is driving insights for the runner. We match that with what we call Run Insights, which is a consumer insights group that we have at Brooks. Right. And they're matching the biomechanical science piece to what runners want, experiences, emotions, and the like. And that is just a beautiful marriage for us.
So help us understand your demographics, because I hear it's runners, but I mean, there's a lot of older folks that are wearing them.
Hey, they got wide shoes for people like me.
Yeah, they got wide shoes.
So thank you.
So I am curious about.
If you put one foot in front of the other, you're a runner. Walking, slow running in our building, right? And so we are in the business of movement. So if you get up every day and you're moving, we have a product for you. That's how we think about it. Our strategy and our biomechanics is designed around the runner. But if you move, if you put one foot in front of the other, you're our consumer.
All right. We're talking with Dan Sheridan, CEO of Brooks Running, here in our Bloomberg Interactive Broker Studio. So going back to it. So demographics, what do you know about your shopper?
Yeah, we know a lot of deep survey data tells us, one, just the journey of running. What we're seeing right now is there's 4 generations. You've got boomers, you got Gen X, millennials, and Gen Z that are investing in health and wellness. Yeah. And so it's the biggest market we've ever seen. What we know about Gen Z with this new generation is they started running earlier than any other generation, maybe all time. Because of COVID, they were at home with their parents and they started running at the age of 11. My generation, when you got to high school, you started running track, cross country. That was the first time. So what we know is that is coming towards us in a big running boom right now. And they're paying for it.
And you are seeing that.
We're seeing it. We're seeing it across the globe.
You've been at Brooks for longer than it's been owned by Berkshire Hathaway.
Correct.
But I'm wondering what it's like to be an independent subsidiary of Berkshire Hathaway.
I often say that I have the greatest job in sporting goods because of our ownership structure.
Do you report your results right to Warren Buffett?
We do. We report up through the Berkshire family, and we're fortunate. Ownership matters in business. And what I often say is my competitors that sit in a seat like mine operate on a 13-week calendar. I get to operate on a 10, 20, 30-year calendar. We make decisions for the long haul. And there's many examples at Brooks where we have disruption. Trade is one of those where we play the long game.
Does Warren Buffett pick up the phone and call you? Can you pick up the phone and call him?
I see Warren once a year at the shareholders meeting.
That's what a lot of people see.
I get so excited when I have any amount of time with him. I more frequently talk with Greg Abel.
Which a name that would be very familiar to our audience. But is Greg doing anything day to day, or is all day to day to you? And you essentially report some sort of metric to him quarterly?
So Greg's available whenever I need him. And we do regular check-ins through the year. But most of the time, the culture of trust and the culture of decentralization that everybody reads about and hears Warren talk about is really how we run the subsidiary. And we run our own shop, and Greg's there when we need him. And it's a perfect scenario for our business and a long-term approach in which I'm very appreciative of.
All right, Greg Abel, obviously the CEO, along with Warren Buffett of Berkshire Hathaway. Dan, thank you so much.
Thanks
Good
for
luck.
having
You have a runner in the race?
We have a lot of runners from Brooks, employees, and some of our professional athletes this weekend. We'll be out on course rooting them on.
All right. Well, good luck to all of them. Dan Sheridan, CEO of Brooks Running, joining us here in studio in the Bloomberg Interactive Broker Studio with Brooks sneakers on.
Oh, yeah. Always, I bet.
I bet. I can only imagine how many pairs.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.